Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of Fintech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm joined by Michael Perito, head of corporate strategy at Provident Bank. In this episode of Banker's Hours, Mike and I talk about his career change from a sell-side bank analyst to being inside a bank, now helping Provident execute and communicate its strategy. We also talk about some trends he expects to see in 2026, including why he thinks interest in bank deals will remain high, how he thinks about asset size in banking, and why banks need to focus on developing their core customer profiles. Hi, Mike. Thanks for joining me today.
You're welcome. Thanks for having me.
Well, we have chatted over the years as in a bunch of different capacities, and I'm so excited to kind of bring you the culmination of your experience to this conversation today. My first question for you is, tell me a little bit about yourself and something your banker colleagues might not know about you.
So most of the different perspectives in our prior conversations were my fault. So me jumping around a lot. So, I'll take the onus on that.
Yeah,
but
mine were always journalists, and then you would just change your titles afterwards and the email addresses I had to contact you at.
Hopefully I'm making progress, but I think the end will justify the means. But so I've been in the banking world for about 15 years. I've pretty much lived in the metropolitan New York area my whole life. So I'm kind of an I-95 rat. I grew up in Westchester County, went to Villanova, and now I live in Monmouth County, New Jersey with my wife and 3 kids. And so, I think something they don't know about me is I love being outside, and so like my wife and I, we live down by the water in Monmouth County, and I try to get my kids and everyone out on nature trails, beach, whatever we can. Obviously we spend a lot of time in Excel and at desks and things of that nature, and lately not so much because it's like a polar vortex, but in the summer we try to get out as much as we can and enjoy nature.
I decided to try to visit all 50 states, and when you do that, you have to define what a visit is. But when I was making my list, I realized I don't think I've actually visited New Jersey because I'm not counting airports.
You have to leave the airport and have a meal.
Is that your definition?
That's my definition, because I've been to 37 states, and I've been to the whole Midwest. Because of my job at KBW, I started covering Midwest depositories, and so once I got the Midwest knocked out, I was like, I'm going to have to do it all. As an East Coaster, the Midwest is probably the hardest one, and I've been to every single one. So now it's like, all right. So I'm with you, actually. It's funny that you mentioned that. Yeah.
Well, I haven't been to New Jersey because, again, we're not counting airports. But in my head, New Jersey is not like a nature-forward state. And so it's interesting that you made that connection for me. And I guess I will have to go see for myself when I visit New Jersey, as in leaving the airport.
The metro New York area is interesting. I would say New Jersey, New York, like people tend to focus on that little metropolitan New York City area, and it's densely populated, but it's such a small component of the whole area. You have the mountains going through both states. Like upstate New York is like it's more like the Midwest than it is Manhattan. So like New Jersey is similar in that regard. You kind of have northern New Jersey and everything, but then you have the beach coastline, which is huge,
and
then
shore.
South Jersey,
I know there's a shore. I'm familiar with
Philly
that.
suburbs. So there's a lot to see. We'd love to have you out.
Well, so you mentioned KBW. I don't know did you start your career in banking as an equity analyst at KBW, or I don't know if it was a predecessor.
Yeah. It was my first job out of college at KBW.
Amazing. Well, and now you work at a bank. So tell me about this career path, and tell me about where you stopped in between and why your email address keeps changing for me.
Yeah, so, I always joke, I can't lie to you and tell you I always wanted to be a banker, it wasn't.
Like, you didn't go to, elementary school on, career day, stand up and be I want to be a banker.
I was actually the first person in my family to go to business school, so, it was not something that was preordained. And then when I got to KBW, they were like, work on the bank team, and I was like, sure, I was happy to have the job at a decent, reputable place, and But banks interested me immediately because they have a very weird connection to everything, which I didn't really think about, and unfortunately, lots of times you have to become experts on things when things are going poorly, right? It's like there's an energy crisis, like figure out which banks have the energy loans and how they're under it. It's never like when things are good. It's always when things are bad. But, I immediately got interested in how banks are kind of connected with everything and really jive with the overall economic conditions and whether that's GDP growth. And so like their interconnectivity kind of is what drew and keeps me drawn in, even though I can't say I was a lifelong set banker. But I really, and then the other piece is I really grew an appreciation for the small community and regional bankers, the work they did, how it was interwoven with the places that they lived and called home. And when I think about a big reason for my transition from investment banking to this side, that was a big driver of it. In the investment banking world, it's more of a numbers game. It's a transaction game. And now those things still matter a lot, right? You have to have good returns. You have to grow. You have to have a good idea of what drives your business. But there's more of a people component to this new job, which I've really enjoyed, and I think I'll continue to.
Yeah. So you worked on what we call the sell side.
Yep.
And now you're not on the buy side, but you're like interacting with the people who are on the sell side.
Yeah. I'm definitely not on the sell side anymore.
Tell me about that transition and what is it like to interact with people who like used to have your job, basically?
I'd like to think I have a pretty good appreciation for the job. It's a challenging job. It's hard work. You learn a lot. It's also changed a lot, the sell side.
Okay.
It used to be a lot of longer. Like I'll just use Provident as an example. We have about 5 analysts that write research on us. You go back in time, and those 5 analysts were pretty well known people within the investment community. People that have been at a KBW or Sandler O'Neill or Raymond James for 15, 20 years and covered the space. Now it's a lot of younger folks that are trying to build their reputation. There's a lot less senior people covering the space for a variety of reasons that are probably worth a separate podcast. But, so I try to be mindful of some of the things that they're balancing. One of the things I always talk about internally here about our own investor relations strategy and our communications is, we have to make sure we are telling people really what we want them to hear. And I know that sounds so simple, but when you just hit people with tons of SEC language and like really dense releases with no bullets, no highlights or no takeaways, like you leave people to come up with their own. And 10 years ago, when you had 5 20-year vets covering your stock, maybe you were okay with that outcome. But now, I think it behooves you to be more, take more ownership on the types of communication you're having and making sure people understand what's really important to your story and what have you. So, I think I try to have a really good appreciation for some of the challenges. But I also know some of the tactics as well, and at the end of the day, it's called the sell side for a reason, right? And it's a transactional business. And I think it's important for banks, just like ours, to really understand what outcomes we want and then what transactions may or may not get us there. Because if you get in a transaction conversation without a good understanding of your outcomes, that's usually where mistakes happen, where you do a transaction that doesn't work out or it maybe investors aren't kind of aligned with your thinking. It's because you haven't really communicated. If you have clear outcomes and clear goals and you work backwards from those, I think it cuts a lot of that interference out. So it's definitely been fascinating, but it's definitely helped me, Yeah. I think I'm more effective in this role right now because of that background than not, for sure.
Yeah. You definitely know your audience, or that segment of the audience and what's important to them. Something that because I've never done equity analyst, I'm not, and my personal thing is like, I probably shouldn't own shares in companies I cover. That comes from one of my old employers, that philosophy. I think it's just pretty easy to avoid that conflict of interest. But I've never understood kind of the tension between expectations and results. And so when earnings would happen and a bank made more money than they made last quarter or last year this time, but it wasn't as much as what someone thought that they should make. And so shares fall. And it's just like that kind of business of the expectations management and the almost like you're punished for not meeting someone's expectations. And I'm like, well, that's like, to me, that's fake. Like, that's not real at all.
Yeah.
So
it's a very interesting thing you just brought up, because it's first of all investors might have different time horizons.
Yeah.
Right. And you're managing a business for long-term success, and quarter to quarter success might be a step to that long-term success. Well, like if we have the opportunity to make a big investment in something that we think is really going to change the trajectory of the company, we're going to do that. It's our duty to do that as we try to build and compound value longer term. But someone that was just trying to own our stock for 90 days might not love that investment, and so you have this push and pull and that goes back to the IR communication strategy piece, where we really just got to be transparent and try and have good dialogue. And then, like, if you tell investors that you are always going to be proactive when you see an investment opportunity that comes up, and you're very clear about that, at the end of the day, they might not be happy that you missed on OpEx in a particular quarter, but you laid the groundwork very clearly of how you're going to manage the business, right? As the trend of investing has gotten shorter term in time horizon, right? As hedge funds have gotten so you have probably more passive trading than ever before.
Sure. You
have more retail involvement than ever before. And then you have, on the institutional side, even if you take that part out, it's more hedge funds than it used to be, like money market, like long only mutual funds, things of that nature, right? Mm-hmm. And so for more so than ever before, you have a really diverse audience, and technically you have a fiduciary responsibility to any investor of the bank. And so it can be challenging at times. I think you really got to level set what your 12-month financial expectations are and what your strategic roadmap looks like, and then execute it to the best of your ability, and just try and be a well-balanced bank in terms of capital return, investing for growth, driving profitability improvement. But I do try to not get too bogged down with if you miss a penny for something, right?
It's your math, buddy. You fix your math, right? I
look back at Provident Bank's 2025, and we accomplished a lot of great things. We grew the bank. We improved our profitability. We grew tangible book value 15%. There's a lot of things that we did that we feel really good about, and things set us on a good path going forward. Did everything hit the consensus expectations out to the extra penny? I don't know. But it can be challenging from time to time. Sure.
Okay, so you're the head of corporate strategy. Tell me about Provident and what this job entails.
So this is the first time Provident Bank's had a head of corporate strategy. If you think about it, it makes sense. It was, the culmination of the Provident Bank Lakeland Bank merger, which effectively doubled the size of the bank. So you went from having a 14 and a 10 billion asset bank to a 24 billion asset bank.
Sure.
And at this point now, as you get larger, there's just more skills you need internally, right? I think going back to the sell side, my sell side days, I dealt with a lot of small banks, let's call them under 10 billion. They're usually very top-heavy organizations. You have one or two people that are making most critical decisions, right, and driving the bank forward. Mm-hmm. When you're 25 billion, that can't really be the case anymore. You need a talented executive team. You need people that understand what the strategic direction is of the company, and you have to have the resources to help those executives execute the plan. And that's effectively where our head of corporate strategy comes in, right? So, I help put the strategic plan together for the bank, and help the top executives and the board kind of identify what our go-forward strategy is, where we want to be competitive, where we want to invest. And then once that whole plan is agreed upon, you then move down to the next layer with the executives and the senior management group to help execute that plan. What resources do we need? Where are we deficient in talent or process or product, right? And trying to connect all the dots together to make sure the outcomes are what we're striving for. So, in a really simplistic description, that's what the job entails. I think the nitty-gritty of it is really trying to identify the areas where you have to spend more time or less time in any given rolling kind of quarterly period, right? Like, as you could imagine right now, there's an intense focus on deposits, right? But there, not that long ago, it might have been more on the balance sheet interest rate risk side, or what are we doing there? So it's being flexible, but that's how I describe the role.
That's cool. And it's interesting. It makes both sense to me that a bank that has like kind of doubled in size and maybe its identity is changing, or it understands that it's going to be needing to make changes, would want to add this role. But like, when do you think banks should be thinking about getting, someone whose kind of job is like strategy, crafting, articulation, and then the actual like the communication on how we're going to execute and how we're going to kind of keep track of that, and when we will adjust and why?
Yeah, I mean, the flippant answer is as early as they can, but I think in practice that can be challenging, right? I mean, I'm sure we'll get to this at some point, so I don't want to lead the witness, but lots of discussions in banking around scale and is bigger better, right? And we could talk more in earnest about that later if you'd like. But what I would say is, in terms of attracting talent, being larger does help, right? Sure. Like if you're $5 billion in assets, it's hard to rip somebody from the sell side and pay them a bunch of money to do your strategic planning process. Like especially if your bank's really not built to have that role be successful, like from a decision-making tree standpoint. So, sure. I think as early as you can, but I would pivot it a little and just say, no bank is too small to add people to their payroll that understand the big picture. You might have to give it might not be a head of corporate strategy role. Maybe it's a chief strategy role, or a chief financial officer pivot, away from somebody that maybe you just split the role of CFO and chief accounting officer, so you get some more strategic horsepower in the CFO seat. There's no one way to kind of skin a cat, but I think you need more people. The more people you have involved in your bank that understand how all the pieces connect together and how you create value longer term, the better off you'll be. And so, hiring a head of corporate strategy is nice. You see a lot of banks that are in that surpass that 15, 20 billion in asset range begin to do that. Yeah. But it doesn't mean you kind of have to get by with no strategic thinking below that. I think it just might look a little different, or your resource allocation conversation might be a little different.
So 2026 just started, and we, before we started recording, we were mentioning a deal, and that's, I think, going to be a big theme of 2026. Yeah. What is your current outlook for the banking industry over the next 12 to 24 months, going back to that kind of long-term positioning? And where do you see Provident, like, kind of moving with the banking industry, or moving with your prediction, or like going against what you think is going to happen?
Yeah. Well, I mean, the first part of your question is fairly succinct and easy to answer. I mean, pretty much anyone you talk to says there's going to be more bank mergers. The pipelines are full. All the investment bankers will probably be be acquired this year.
Which is happening right now. We're recording right now. Neither of us are there, so we weren't sent, but everyone else is there.
We were invited, but we decided we had better things to do.
You didn't want to leave the cold of New York to go to Phoenix. That's very big of you. What a sacrifice you're making for the bank right now.
Dedicated to the cause here. But, I think there's going to be more, and there should be. I don't know, like, I don't want to get dragged out into a long, like, what's the right number of banks conversation. We could do that maybe in a separate podcast. But, I often go to conferences and I hear a bunch of people complain about their valuations. And it always kind of makes me laugh because, like, as an industry, we've accepted mediocrity as a good outcome for far too long to be able to stand on a soapbox and complain about our valuations. Like, sure. You want to be valued higher, go do something about it. Make more money, be more profitable, grow on your own organically, right? Like, it's not just, you're not just going to wake up one morning and all of a sudden the value you create is different than what it was for the last few years, right? So there's far too many banks that are under creating their own value, and they'll continue to be consolidation because of it. Now, the flip side of that equation is there's an incredible amount of banks that look very similar on paper. Yeah. So the dance card math, I think, is a lot different than it used to be in terms of, am I an interesting target for a buyer even? Am I that different than the other community bank in the next town over that's having the same types of problems I'm having? Mm-hmm. So you mentioned Provident. I think for us, the real key, what we communicate to our investors is, we want to keep ourselves positioned to have all our capital optionality. And the way you do that it's really simple. It's just you have to be able to organically grow, which is our priority, and improve our profitability, and which we're doing. And as long as you can do those two things, I think you control the roadmap more than you don't in terms of your options to be on either side of an M&A transaction, or to sit out. If you really just don't feel like there's something compelling enough out there that's worth disrupting your organic growth momentum, every investment banker will come in and tell you, now's the time, you got to do a deal. I don't buy into that at all. If there's a good deal, we'll look at it. And if not, I'll just continue growing 5% and trying to make more money on what we have and wait for the right opportunity. If you're not growing, then I think that's where you start to see the pressure seep in, and where people do things just to do something. That's not our position at all. We have put a lot of investments in to drive the organic growth of our bank. That's where we spend almost all our calories on a day-to-day basis. And because of that, I don't have to feel that pressure. If something compelling comes up, of course we have the horsepower to do the work. But if not, we are fine to sit out as well. And so I don't know that that's how all banks think about it. I know that's not how investment bankers think about it, but that's how we're kind of running our business. And I think it's the right way to build value longer term in our franchise.
One thing I do kind of wonder is, one, it's funny. So you mentioned all the M&A that's happening, and it reminded me that I have a note to myself to write an article that explains purchase accretion in accounting, because I feel like we're about to kind of hit the stride where the earnings results are going to get really confusing, and it's going to be actually kind of difficult for observers to kind of tell who's making the most of a deal, or who has to keep buying banks in order to keep having good results. And that's actually a really important, those are two different things. But to your point about being an operator and focusing on organic growth, I mean, I feel like, one, that's kind of a thing you can control the most, even though you kind of can't control. And I actually do think that part of me is how much organic growth is even available? Is this pot of available 100%. Growth that's available growing? And how do you increase your share, or how do you grow the pot of organic growth, right, itself? And so it is interesting to think that I would hope that banks, and there's 4,000, so there's probably a big diversity of practice, but banks understand that what they should want is flexibility. You should want capital flexibility. You should want a lot of options for build or buy, or partner with a fintech or whatever. And that's probably, I kind of felt during the pandemic or during the financial crisis, the banks that do the best were the banks that kind of went in the strongest and had the most options available to them and could buy and strike, or they could wait, or that, you know what I mean? And they had just a lot of choices, and there wasn't urgency or desperation on their part to act,
No, and it's because, honestly, they probably had a multi-year planning process of understanding the outcomes and objectives that they were trying to achieve. And so then when those opportunities come to you, you're looking at them in that lens, and you're understanding what their value is to you because you understand where you're trying to go. If you really don't know what you're trying to be, then it's hard to understand how any particular piece on a journey will be additive to that. And again, some of this stuff just sounds so simple.
Yeah, of course.
But then, my year in between KBW and Provident, I worked at Trevelyan, and I was doing strategic planning and investor relations consulting. And, you get into some of these strategic planning documents, and it's bullet, we want to grow loans.
Cool.
Okay, so does everybody else. What is that? What kind of loans do you want to grow? Are you want to? Do you have for example, at Provident we have a initiative in the middle market, right? Being specific, right? And our view is simple. It's you just saw the USB bought BTIG. The largest banks continue to run towards capital markets, right? They want investment banking, IPOs, they want the securitization desks, they want all these things. And as a result, their commercial banks are following suit, right? They're looking for prospects and lenders and customers that can target those services,
Yeah,
right?
who need those services, yep.
Exactly. And so then you have a bunch of smaller banks, right? Because you mentioned there's 4,000 banks, 3,900 of them are super small, right?
Right.
So, they're not going to be able to originate a $75 million middle market loan because they're only $1 billion in assets. So now you have this gap competitively where there's customers that have large businesses, let's call them 75 to $500 million in revenue, but they don't have like a capital markets component to them necessarily, but they're too large to deal with a community bank. Like who's going to service them? Who's going to fill that gap? And, so like we're trying to fill that gap, we've actually hired a new head of middle market that starts today.
How exciting.
That came over from a larger bank. And but that's like a very specific objective. And then we're going to have tactics below that objective to try and grow our market share. Just growing loans. Like, again, back to that comment about, you want to hire valuation, don't be mediocre. Like, of course you want to grow loans. I mean, like we're spread lenders, that goes without saying. So, I think that's something that people would benefit from, going that layer deeper, understanding your outcomes. And the good banks that have done really well, the ones like you're referring to, they all understood their roadmaps, and that helped them take those actions when the opportunities presented themselves decisively, and it doesn't just happen overnight.
Well, so you've mentioned valuations, which I think is interesting. It's a byproduct, right? Like you do the work and then you get the valuation is a result. And it's kind of one of those things where like, if you exercise a lot, health is an outcome, right? Like like you eat right, whatever, you get these outcomes. You can't necessarily control the health, but you can control the things that like produce health or whatever. So for you, based on your experience and what you've seen, what does it mean to be a high-performing bank in 2026? And how do you think banks can like define or explain their value proposition in the face of like a lot of competition from institutions that look exactly like them, and then institutions and tech companies that look nothing like them?
So I'll answer that in a couple different ways. I think, in terms of high performing, I try not to overcomplicate it. There's a lot of data out there. Like what's the top quartile of banks over 10 billion doing? Is it a pre-provision net revenue return on average assets north of 1.8%? Okay, well then that's where we want to be. We want to be a top quartile performer. There's nothing.
That's the metric of the top performers. Yeah.
Short of tax rate, which is pretty onerous in our state. There's really nothing that we shouldn't be able to not do that they're doing. So like, I don't. Why are we going to sit here and rationalize why we're below a certain level? Like to give you a quick personal anecdote that I tell people all the time, one of the reasons why Provident was so attractive to me and I was happy to join here is because I was very weary of joining a bank where it's like you moved hell or high water and then you're like, oh, we hit a 1% ROA in 2027, like would be, like that's less enticing to me. Like I'd rather be somewhere that actually has a chance to be a top quartile performer and then try to be a part of the team that drives that outcome. And so like on that perspective, I really try not to overcomplicate it. I mean, you could if you want, right? Yeah. But it's banking is somewhat of a simple business, right? You're managing risk. You're trying to compound your book value and your earnings per share and do so in a profitably way. And the banks that find that recipe of success and sustain it over a long period of time typically get the valuations, right? If you're up and down and all over the place and not consistent, and then your valuation will suffer. Yeah. And so generally that's how I try to think about it. But then the other piece you brought up that I think is really fascinating is the value proposition, because I think one thing a lot of fintechs are finding right now that came in heavy into bank product offerings, whether as banks or with banking as a service part, however they kind of logistically did it, is banking products are heavily commoditized. Like you could razzle dazzle a checking account, but not that much. Like there's a certain functionality piece that you have to hurdle, and then the other stuff, everyone will, if it works, everyone will be right behind you in line. Like for a couple of years, the paychecks 2 days early was different, and then all the fintechs offered it, right? It's not a space where you can create products that really have high barriers of creativity. Mm-hmm. And so when I try to think of Provident Bank's value proposition, I really try to think about it holistically from a customer perspective. Like, let's be the bank that can grow with you through all your different phases of life. right? So yeah, you're a student, you need a basic checking account. Of course we could offer that. It's really not that hard to do so. Now, are we going to make a ton of money on it? Maybe not, right? But where you make the money on that customer is keeping them on the platform, adding the savings account, doing the mortgage, doing the home equity line of credit. Maybe you take over, like for Provident, one of our big differentiators is our insurance agency that we still own. Most banks have exited.
Nope. They don't have insurers anymore.
When I joined this was the old sell-sider, Mike Perito, I was like, we got to, sell the insurance agency because it's probably worth a good amount of money and we could leverage the capital elsewhere. And then now I look at it and we're actually very profitable in that business. It's one of our highest growing businesses, and more banks choose to exit it because they couldn't figure it out. And it becomes more and more differentiating as we can be successful in it than it was even 5 to 10 years ago. But back to that roadmap, add the insurance, whether it's house insurance, car insurance, and then eventually when the assets reach a certain point, we could bring in our wealth component and help with the retirement planning or the estate planning or all those things. And that full life cycle, and not every customer is going to value that life cycle, and that's okay. If you want to buy an eighth of a share of Amazon and gamble on futures markets, like Provident's probably not the best bank for you. And there's, we could debate whether that's right or wrong, but there are a lot of regular people that would value the continuity of a partner like that, that can give you expertise and products along your whole journey. And let's focus there, and let's focus on those people where we could actually make a difference, because each individual product on the journey is not going to be that differentiating.
Well, it's interesting you pointed out two things. One, that like bank products are super commoditized, which I totally agree. And then two, you kind of mentioned a customer life cycle, and then you've also mentioned this middle market focus. How did Provident scope out its core customer? How would you have recommended banks scope out their core customers? And then how do you also identify the competitors for that customer and how you're going to keep the customer from those competitors?
Yeah, so the banking business right now, going back to front there, it is very competitive, and so there's an increasing amount of work we do internally every day to understand our profitability and the drivers, because you really have to get how I've heard a lot of bankers talk about the top. Well, so bankers call it loss leaders, fintechs call it the top of the funnel. It's the same thing. It's the stuff that you offer, probably not with great economics, in the hope that the customer engages with you in more profitable ways. If you're not measuring it, though, it's hard to know whether that strategy is really playing out, right? So, I think we really try to understand our internal profitability so we can make data-driven decisions on something. So some big municipality wants to bank with us in a vacuum, isolated. Maybe the economics don't look that great, but we know that XYZ opportunities will come from this. And then, so we decide it's worth going. You have to understand those puts and pulls. Otherwise, you're just going to end up with a big portfolio of unprofitable banking relationships, right? Like, that aren't generating anything for you. So, I think that's understanding that piece is how you kind of deal with competition. You also have to, like I say this somewhat jokingly, but Provident Bank's been around since like 1839. You kind of just have to outlast stupidity sometimes, right? Sometimes someone might just be desperate to grow. It might be willing to do that 10-year IO commercial real estate loan. And at some point, you just have to know what your backbone is to say no. Like, where will you just not go over, right? And that's where having a good treasury function and understanding kind of the pricing and the balance sheet and your interest rate risk profile and where you want to stay within all that stuff, that's where all that stuff kind of ties together. Most of the banks that failed in 23 were not bad banks before that, but realized that they had pretty mismatched interest rate profiles, right? Because they were probably doing a lot of things that were deemed to be loss leaders for the greater good of the business. And those loss leaders were these 10-year fixed loans at 2% that all of a sudden became very upside down pretty quickly. Hindsight's always 20/20, so I don't say that in a judgmental way, just in a factual way. But so I think, tying all those pieces together can help you have the confidence to outlast some craziness in competition. Quick anecdote, I saw that Genius Bank was being wound down. I don't know if that's true or not, but there was a while when it would come up in meetings and people were like, who's this Genius Bank offering 4.9% money market rates? And, I would just kind of say, guys, like, if we're going to lose to that, we're going to lose to that. Like, we can't,
we're just not going to play in that space. So if that's, I'm not a chief strategy officer, and you make it look easy. And I think, like, actually one of the things
I need to have the job longer before you start throwing praise at me. But I thank you.
But I think there's a real truth and tension of, like, none of this stuff, like, it's none of this stuff is, like, complicated per se, like, but it's that discipline and the focus that's hard, which is, like, every single day to wake up and be like, we're not going to win, or we're not going to compete for these types of in this area. So if it's price, we're just not going to do that. But that doesn't mean we, like, necessarily, like, you're going to lose some people. You're just not going to be the bank for them. But there might be some people that would be swayed by price, but also could be swayed or kept or convinced on another thing. And I was talking to someone yesterday about the difference between value and price, and that you need to explain why you're valuable, or you need to attract people who value the things you offer, and that's more work than just competing on price per se, right? Like, that's to understand you as the institution, and then you as the core customer. And explain it, and then really try to, like, speak to those people and be okay with, like, not being the bank for everyone, or being the place for everyone. So I think that's, like, a really interesting, and none of this is, like, you and I are not the first people to say this on a podcast, right? Like, not even on a podcast, right? So it's just so, but it's like, these truths in our industry, right?
Break a new ground here in Bank Nerd Quarter.
I know, right? Okay. Oh, yeah. What were we going to say?
Yeah. No, go ahead. No, I agree. I think everything, it's the discipline component can be challenging, particularly when you're in a competitive scenario, right? And you don't want to lose a customer, or you don't want to, and sometimes you shouldn't. Like, you lose a customer over 5 basis points. You shouldn't. Right. But maybe you should lose a customer over a 15-year fixed loan. So you just got to kind of understand where you're willing to push, and I do bring it back to that. I think the first part of your question we didn't really get to, but understanding your customers, the segmentation of your customers, and what's valuable to them, and then having the data to understand the profitability of all that stuff helps you make those decisions of where you can push or where you have to maybe deflect, just be like, this is not the right opportunity for us right now. But it's kind of a journey, because it changes a lot too. I mean, just think about how much rates have moved and all the different things with QE, and, like, there's all this macro stuff going on, and so just when you think you got it figured out and you understand your tolerances and everything, then it's like a whole new different world, and so it's definitely it is simple, but it's not always easy.
Yeah. So how do one of the things I think that is a real pressure for the traditional commercial banking space is the non-bank tech firms that are coming in. And I think a couple years ago, it was maybe focused on the retail consumers, but now there's, I think, some pretty compelling business or small business offerings. How do and when I was at Bank Director, we would do surveys, and we would always ask, like, who do you consider you to be your biggest competitor? And many of the respondents are still rating, like, an institution physically down the street from them that often, I think, like, looks like them or is like a credit union. Yeah. And I was always surprised that tech firms didn't rate higher in that kind of competitive analysis. So how do you think about non-bank tech firms that are more competitive for customers or for products rather than complementary?
Yeah. So I think there's a qualitative component to this conversation, which is just, even if you don't think they're taking your customers, they're impacting how your customer expects to interact with you, right? So, like,
sure.
For anyone who's just not paying attention at all, I struggle to see how that's the answer, right? I mean, even if you don't think you're going to lose a customer to Chime, like, you can bet your bottom dollar that customers are over time going to be influenced how Chime offers its products. Like, you have to know what's going on.
Yeah.
And I do think, I might get some blowback for this one, but I do think sometimes some of these platforms are over jazzed. Like when I was at KBW and I led digital banking research there. So I covered all the banking as a service banks, SoFi, Lending Club, Silvergate while it was around, and I did the neobanks. So most of them weren't public at that time, but like I followed all of them. And as a function of that research, I would be like, all right, let me apply for a mortgage on XYZ bank and let me apply for a mortgage on XYZ app, and I think the gap sometimes perceived to be wider than it is.
Okay, that's good. That's a good takeaway.
Not uniformly, right? There's always exceptions. But if you go to like a reasonably invested community or regional bank, right, that's spent a few dollars on some things, and it's not like you could drive a tractor trailer through some of this stuff off. Like once you're on Mantle or Narmi, you're opening an account in less than 5 minutes, right? Doesn't matter if you're XYZ regional bank or you're high-powered fintech. So I think sometimes those gaps are a little oversold, but I think understanding what they're doing is really important. And then the other thing is, there's not a ton of work that's a lot of what those fintechs are doing, in my opinion, is they're taking all the new customers.
Sure.
That's harder to see as a legacy institution. It's because it's not like you have droves of people leaving to go to SoFi, maybe, right? But maybe your inability to draw new people to the bank is because they're all going to SoFi. But they're not, you don't have that data, right? Because it's not like you can look and see, well, where were these accounts that exited? Where did they fund to? When you look at that data, it probably says, well, this one went to XYZ bank across the street. This one went to Chase. This one, but how much incrementally are you missing out on that you don't even know about because you have no way to track it and no way to understand it? And so I think that's also part of the problem when people underestimate fintech competitors is they're just looking at their portfolio and what am I losing?
Yeah.
Oh, it's not that much. But I haven't grown customers in 5 years. Well, maybe that's why, it's I think that's some of the dynamics that are going on.
That's like that long-term relevance question too, is like, and I think like I want to write a piece, like this is gonna be a long-term project, but like I want to look at demographics and like what does it mean that we're gonna have we have shrinking demographics, like where population is shrinking. So you're like, oh, I need to reach like Gen Alpha, and that's fine, but like also like one, are they even like aware of your bank? Are you able to market them and find them before when they need to change banking relationships or to keep these banking relationships? But also, what are you going to do when the group of people you're going to sell to is shrinking? Going back to like how much growth is actually available, and it is interesting to think that like, sure, you might not be losing consumers today, but like what will happen over time is your customer base gets older, and then they're not replaced. And I do actually wonder how like big of a challenge that is for community banks where your customer base has gone from like, average age is 40 to now average age is 50 or something. Like we just don't have the like new blood or new customers coming in.
Yeah. No, I it's something I spend a lot of time thinking about. The nice thing about it is, despite what everyone on LinkedIn wants to tell you, it's not going to happen in the next 12 months. It's like community banking is not going to die in 2027, right? Yeah. Sometimes I think we just got to say that out loud because some people it's good for their business if it would, so they tell you that on public places, but it's not the truth, right?
Yeah.
The average person lives to the mid 70s, so even if your average customer's in the mid 50s, you got 20 years to figure it out, right? But
Mike, that's not the takeaway of this podcast. Is that you have 20 years to figure out your demographic problems.
Yeah, I'm somewhat kidding there, but no, I think it is understanding that kind of jokingly comment I made early on about like if someone wants to buy an eighth of a share of Amazon and bet on futures markets for some cryptocurrency like Provident Bank, we're not going to offer you that, right? And that's okay. I mean, I do think there's a financial literacy component going on in the consumer space now that's very misguided and very scary. In terms of, I think giving access to things to people is great as a concept. Like, why should an institution get the advantage of doing this when, the average person on the street can't? But, you don't have to be that financially trained. Like, I did some of the CFA stuff, like, the IPS statement. Like, some people just shouldn't do things because it's not in their risk tolerance,
Yeah.
And I think sometimes we forget that, like, it's great that you want to offer IPOs to everyday people. But, if an institution messes an IPO up and loses 10 million bucks, they're going to go on. If a consumer puts their life savings into an IPO because you let them, and you really didn't ask them the right questions as to whether that was in their risk tolerance, like, shame on you, And right now, though, I don't think that logic is driving consumer behavior or competitive behavior at all.
I don't think that message resonates right now with a lot of consumers.
No, but this is a good example of kind of playing the long game, like, and understanding what customers you can attract, and going back to that value proposition, that life cycle financial partner, right? Like, someone who sees value in that, wants to be educated, wants to make smart decisions. We got to go full court press on those types of people and get them into our bank and give them what they're looking for, and not waste any calories chasing someone that wants to buy the next big IPO or something, and if that person changes, and now obviously this is like an oversimplistic and perfect exercise because you never know exactly who values what and what's going on. But you have to find channels to market in, like, where people are, looking for that financial literacy component or that, like, journey component. And it's challenging, but I think those are some of the conversations we're having. Like, how can we be more tactical in attracting customers or getting on the wavelength of customers that we think we actually have a chance to help and make some money off of versus, the person that's, just going to want the highest money market rate and going to move their money in and out to buy Bitcoin when it's down 20 and up 20. And again, like, I'm really not trying to be judgmental, but, like, how can a bank like ours compete for that customer? I mean, you can't.
You can't. So Provident realized when it hit 25 billion that it probably needed to add this, this strategic role. And you alluded to this. Is $25 billion a big bank or a small bank? And, like, how should we be thinking about scale as it relates to asset size? And then actually, I've been thinking about if you were going to measure bank, like, I think about how, like, the BaaS banks, like, asset size is not a good way to measure them. And, and like, is there a different metric we should be using to measure whether a bank is, like, to measure banks, I guess?
To be determined,
Okay. Thanks.
I do think there are some trends going on that people don't want to talk about because it's a very grow your assets, keep your NIM here, and you'll make more money mindset in the industry, right? There's a lot of non-bank, non-fintech firms that are putting paper on, like the private credit shops, things of that nature, right? There are a lot of trends going on, and that could change the way we think about balance sheets as a component of profitability over a 10 to 15 year period. And so, like, that's something I pay a lot of attention to, and try. And it's early. Like, I don't have a strong opinion to give you today, but, like, I think it's fair to think that that's going to change the way assets sit in our financial system for a long period of time. And, you could be impacted by that. But, to answer your question, I think Provident, I'm biased, but I think we're in a good spot, So scale for the sake of scale can be a very dangerous game. There are, I'm not going to pick on anyone individually, but there are plenty of large banks that aren't really rocking and rolling, to say the least. So, and honestly, if you're not, being big can sometimes be harder. Like, it's like moving the Titanic, that old analogy, right? Like, the larger you get, the harder it is. Like, no matter how many times I tell myself not to, I still get angry every time I see a sell-side analyst post a slide that shows how much Chase spends on technology. Like, talk about the most irrelevant data point to anyone that understands and has worked inside of a bank before. Like, it means absolutely nothing. if they win, it's because they spent the dollars in the right place, not because they spent $10 billion to keep the lights on a $1 trillion plus asset balance sheet, right? Like, so scale, it helps, but you got to have purpose. And if you're not, the larger you get and the worse your performance get, the harder it gets to fix, in my opinion.
Sure.
And honestly, the least options you have, because there's only so many people that can buy you at that point. So it's not like scale automatically creates value. Now, what I will say is, just looking at Provident for a minute, we've added a tremendous amount of talent to this bank in the last 3 years.
Okay.
A lot of awesome people that I'm fortunate to work with in a lot of different areas: technology, commercial lending, customer experience, on the finance side even, so it is hard to attract that level of talent if you're not a certain size. You just simply, it's really hard to pay for it, frankly, and to give people a platform and an opportunity that they think is worth their time and effort, So I do think there's benefits to getting towards like that 20, 25, 30 plus billion in asset size. But, one of the best banks I've ever been close to was Coastal Community Bank.
Sure.
And they're under 10 billion. And they rock their niche. They do really well where they're focused, right? And so it's an interesting question. I think time will tell. I don't want to sit here and be the guy, like the headline to be scale doesn't matter, because I do think it does matter. But scale at all costs is like a consultant investment banking way of thinking of things. Like if you take two mediocre things and double them in size, like one plus one probably equals less than two, it's not, because it only gets harder and more complicated to run it successfully. So you really need to invest in your team and have horsepower and hungry people like we do, frankly, that can want to be bigger and better and not just like bigger, but better also, and continue to do the good we do locally, which, as you could imagine, it gets a little harder the more regional you get versus like the bank in one county, but it's still an important part of what we do. And so, balancing all those things is really kind of the name of the game.
Well, Mike, thank you so much. This was such a fun conversation. We didn't even get to like half of my questions, so maybe I'll just like save those for part 2.
Yeah, anytime. Happy to come back and chat banks. This is what we live for. So.
Oh yeah. It's funny because I was like, one thing I think, like, I love sharing that, like, other people kind of think the same way and then about banking, and we just occupy different spaces, and so we have these different perspectives that we can still kind of come to. And I think, like, especially right now, so much in banking is changing, but also so much isn't changing. And so that's like, there's a real tension there to focus on, your allusions to what customers want or how non-bank competitors are going to attract them. I think like these are open answered questions. We will be talking about them for years. So I'm sure we'll have many occasions to circle up.
No, I always enjoy chatting. It's, Brett Beardall says it best, like there's not enough passionate people that are proud to be bankers or be in the space. And, I think we should be, and I am, and I enjoy talking about it. I think there's lots of challenges. There's lots of opportunities. And I look forward to facing both of them. So happy to chat anytime.
All right. Well, have a great rest of your day. Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.